Hey guys, welcome to the next video in the series, and today we're going to be talking about the balance sheet. So previously we talked about the income statement, walked through it line by line, and today we're going to be touching upon the balance sheet. Your balance sheet. Right, so your balance sheet is different than your income statement because it's kind of like a snapshot. The key word to remember here is a snapshot. It's kind of just one day in the year, and you're just taking the current assets, the liabilities, the shareholder equity in that one day, and it comes down to the golden equation in accounting, which is going to be your assets is equal to your liabilities plus your equity. That's your formula, and this is kind of how the balance sheet balances out in a way. So, okay, so let's break this down a little further. So, assets is basically what you own, right? This is basically what you own. Your liabilities is basically what you owe to others, right? And lastly, your equity, what belongs to owners, the other owners in the company, right? So if this ever fails to balance in like any situation, just know there's a mistake. This is kind of the golden equation that you got to know. Assets equals liabilities plus equity. So now let's make out a proper balance sheet. So you're gonna have your balance sheet, you're gonna have your date, whatever, and first you start off with your assets, right? So this is basically what, honestly, we could make some more space for us, right? So let's do that. Erase this. So you have your assets here, right? You have your assets here. It's going to basically split up in a little differently. So assets, I'm not going to draw this in yet, but basically your assets are here. And then let's just say your liabilities and equity is right here, your shareholders' equity, right? So starting off with assets, you're always going to start on top with your current assets, right? Your current assets. This is basically cash within a year. So under current assets itself, it's going to be starting off, we can do cash and equivalents, right? How much cash you have and anything that's equivalent to that liquidity. So you have your cash and equivalents, and this is basically, let's just say maybe your money in the bank. Money in the bank. Next, you're going to have your short-term investments. Your short-term investments, basically this is just your investments that can be immediately, I guess, withdrawn for cash, short-term investments. It's just pretty straightforward based in the name itself. It's basically your parked spare cash. That's basically what it is. Let's just write that. Your parked spare cash. And then you have your accounts receivable. This is basically, say your customer took any credit. This is basically anything that is owed by your customers. This is owed by customers. And honestly, it's getting in the way. We can erase this for now. But your accounts receivable, right? Next, you have your inventory in your balance sheet. In your inventory, basically, these are just goods waiting to sell. And asset are just things that are valuable to you. So cash and equivalents, short-term investments, accounts receivable, inventory. These are all things that could get you a profit in your business. So inventory is next. And then lastly, you have your prepaid expenses. Your prepaid expenses. This is basically stuff that's like, for example, rent, someone is paying to you, or anything that's paid ahead, right, to your company. That's basically what that is. That's your starting off with your current assets. After current assets, you come down to something known as your long-term assets, right? Your long-term assets. This is going to include starting off with PP&E, which is otherwise known as your property any property you have, any plant, any factories, anything, or any equipment, right? That's your PP&E. And then you have your goodwill. Goodwill we'll touch on a little more when we get into the cash flow statement when we are talking about acquisitions. But this is basically your premium that is paid in an acquisition. Right? This is your premium paid in your acquisition. Next, we have your intangibles. Intangibles are basically non-cash things such as your patents, right? Your patents, brands, software, stuff like that. It's basically still an asset, but it's not like anything that's liquid or it's a non-cash asset. And then you lastly have your deferred tax assets, right? Your deferred tax assets. What these are basically stored tax savings. These are basically stored tax savings, right? So we broke down your assets, right? Now let's go to the next page and let's put down your liabilities and equity, right? Your liabilities and equity. And basically how this works based on the golden formula that we talked about, your assets is going to have to equal your liabilities, how much ever money that there is in the liabilities, plus how much ever shareholders equity that is. So that's why it's called a balance sheet, because it like nicely balances out properly. So you have your liabilities and equity side, right? So you start off with your current liabilities, just how we started off with current assets. For the assets portion, we start off with our current liabilities. This is basically stuff that's due within a year. And then for assets, it's basically cash within a year. So you have your current liabilities, right? So number one, accounts payable. So we had our accounts receivable in our assets, but now in our liabilities, we have accounts payable, which is basically stuff that's owed to suppliers, right? Instead, we're taking on that credit. We're taking on debt because we're paying with credit for something to a supplier. Next, we have our accrued expenses. Accrued expenses is basically unpaid things or just costs that have racked up. Right, your costs that have racked up. Next, you start off with your deferred revenue. Your deferred revenue is similar to your deferred tax assets. This is basically cash that's taken or work that's owed, right? It's basically something that you're going to do at a later time, but it's still a liability. So that's work owed. Say, for example, that you're going to give some of your working capital to another company to kind of transfer them over to work for them a little bit. That's something that's not going to happen immediately, but it's going to happen over like the year. So it's basically stuff that you owed. It's deferred revenue. And then next, we have our short-term / current debt. Debt's always a liability, and this is basically pretty short for us. This is pretty straightforward. Just any debt that's due soon, right? Any debt that's due soon. And that wraps it up for our current liabilities. Now let's talk about our long-term, right? Our long-term liabilities. So in long-term liabilities, just as how we had short-term debt, we're going to have long-term debt. This is basically stuff like loans and bonds, stuff you're like paying off over a long period of time. And then here you also have your deferred, similar to deferred tax assets, you have deferred tax liabilities. This is basically tax that tax is kind of owed later. Anytime it's deferred, it's just owed later. If it's deferred, it's either owed later or it's kind of stored for later. It's deferred. And then that's basically it for your liabilities aspect of things, right? Let's split this up. That's it for your liabilities aspect of things. Now we come down to shareholders' equity. shareholders equity. So in your shareholders equity, we have three main things, right? We have your common stock and your APIC or additional paid-in capital. This is basically your owner cash. Basically, this is their stock that they own or the capital that is getting paid out to them. This is their owner cash, right? This is the owner cash for any shareholders in the company. Then you also have your retained earnings. My main focus here is going to be talking about retained earnings because the retained earnings is a connector between all three statements, because starting off with your income statement, right? You're going to take your net income and add it to your retained earnings. And for example, on your cash flow statement, you're going to subtract the retained earnings by your dividends. So you have your retained earnings, and retained earnings are pretty simple. Just think of it as your profit that's kept over time. So it just keeps racking up. This is your profit kept over time. And lastly, we have your treasury stock, right? Your treasury stock. These are basically shares that are bought back. And since they're bought back, this is going to be a negative. It's going to be negative. You're basically going to be subtracting that out. And that's it. That's your balance sheet. And like I said, retained earnings is kind of important because it's the bridge between the income statement and the balance sheet. And how this works is like each period of the profit a company keeps, which is your net income minus any dividends paid, gets added to your retained earnings. So the balance sheet like kind of just holds on to every profitable year the company had. And that's just super important to know. So let's go back. So we have our assets here. You have your current assets, you have your long-term assets, and current assets includes cash and equivalents, short-term investments, accounts receivable, inventory, prepaid expenses, and then you come down to your long-term assets. You have your PP&E, goodwill, intangibles, and deferred tax assets, right? Let's go to liabilities and equity. For your current liabilities, you have your accounts payable, accrued expenses, deferred revenue, short-term debt, and we come down to our long-term liabilities. We have our long-term debt and our deferred tax liabilities. That's what's in our long-term liabilities. And then we split that up, and then under it, we have our shareholders' equity. You have common stock, APIC, additional paid-in capital, retained earnings, and your treasury stock. That's it. We've gone through a balance sheet, how it works. And I feel like it'll be a really nice thing if I use for example, a company example like Apple or Google in the video where we're tying together our cash flow statement, our income statement, and our balance sheet. So I'll do that for that, but for this, just understand how this is structured, what each line item is. And that's kind of just the main point that I wanted to get across. I'll see you guys in the next video where we're going to be talking about the cash flow statement.